Hi, my name is Jayashree Krishnan, and I welcome you to this session. So, this is a foundational course in accounting designed specifically for those who are completely new to accounting. So, we have designed this in such a way that all the basic concepts are explained using one single end-to-end example. So, this will make it easier to understand every concept as we go and connect all the dots. There is also a PDF file attached for your reference. Uh, so if you're ready to sharpen your basics of accounting, this video is for you. So we'll be covering the following topics in this session. First, we'll understand the need for accounting. Then classification of accounts into personal account, real account, and nominal account. Uh, the different accounting books, the journal entry, ledger accounts, the trial balance. We will understand the 3 golden rules of accounting. On the reporting side, we'll be covering the income statement and the balance sheet, and also the key accounting principles that we need to know and apply as we move forward. So before we proceed, I would like to let you know that the remaining portion of the video has been paced slowly so that you can, understand the concepts very effectively. In case you think it is too slow, you can consider adjusting the playback speed to 1.2 or 1.5x as suitable to you. So before we deep dive, let's understand the need for accounting. So every entity undertakes several financial transactions in its course of business, right? So basically, accounting is a process of systematically recording, measuring, and communicating each of these financial transactions, and it provides the management with an overview of the financial performance and position of the entity. So basically, accounting helps to keep track of the money in any business. It helps to know how much money is coming in, how much is being spent, how much the entity owns, that is its assets, and how much it owes, that is its liabilities. So we can say that without accounting, it would be very hard to know if an entity is making profit or loss. Entity cannot make good financial decisions or pay the correct amount of taxes or showcase its performance to its investors, banks, or government. So accounting, we can say, in short, tells the true financial story of the organization in a very clear and organized way. So before we move to the end-to-end example of how a company maintains its accounts, let's just look at ourselves as an individual. Okay, so what do we do as individuals? We also maintain our personal accounts, right? So what do? We track on a monthly basis whatever income that we receive. We may have more than one source of income, we track that. Then we keep track of the expenses that we incur in a month. There could be different expenses like electricity bill, grocery purchase, medical expenses, etc. And then we try to understand how much, we are saving in a month, or we set targets for ourselves to reduce the cost or increase our income. So this is the way we manage our personal accounts on a monthly basis. Occasionally, what do? We also keep track of, or we try to assess our net worth. So when I say by net worth, we try to list, okay, what all assets we own. We may have land, we may own an apartment, we may have bank balances, we may own jewelry, we may have invested in mutual funds. But this amount is not our net worth. We may have loans against this or obligations against these, which are our liabilities. So we may have taken a loan for the land, we may have taken the loan for the apartment, we may also have some personal loans, could be anything which are in the form of liabilities. So our net worth is our assets minus our liabilities. So if we're going to translate this and look at it from a business perspective, a company, when they track their income and expenses, or record their income and expenses. When it is done by a company, we call it as an income statement. It's done in the income statement. And whatever assets and liabilities that they record will be in the balance sheet. Okay, so balance sheet is a statement which shows their assets and liabilities, whereas income statement shows their income, expenses, gains or losses. So this is to put it in very simple terms. So in our example, this is savings of 45,000 and the net worth is 39 lakhs. We can also say that when savings increases, what happens when savings increases? It increases basically the balance in the bank, right? Say our salary increases, or we get more rent, or we earn profit from a different source. Basically, our bank balance increases. And when bank balance increases, we can say that it effectively increases our net worth, correct? In the case of a company, the amount that the company owes its owners, or we also call the owners as shareholders, that amount is a liability for the company. And this is because a company must be seen as a separate entity from its owners. So whatever amount that has been contributed by its owners to start the company, it is actually a liability for the company. And this amount reflects in the liability side of the balance sheet, company's balance sheet, under the head stockholders' equity. So here we have the liability side, we have stockholders' equity, and stockholders' equity has different subheads under that. So when the company earns profits, this amount, it flows from the income statement to the liability side of the balance sheet under the head stockholders equity, and it flows into the subhead retained earnings. So when profit increases, that is the net income increases, retained earnings will also increase, and if profit or the net income reduces, retained earnings will also reduce. So now let's start with our end-to-end example. So in this example, Ms. J is starting a manufacturing business, and the name of the company is Clue Manufacturing. So before we start, we need to be clear that Ms. J is different from Clue Manufacturing. They are two different entities. And Clue Manufacturing undertakes all these below transactions between 1st January to 31st December of that year, in the following order listed here. What we are going to do is we are going to go through each transaction to see how it is recorded in the books of accounts, which is the journal entry, ledger, and trial balance. And then we are going to see how that's going to impact Clue Manufacturing's income statement and the balance sheet. And we're going to understand the impact of each of these transactions so that you get a complete picture by the end of this example. And after that, we'll go through some theory aspects which will be very clear to you by then. So here, Ms. J starts business by contributing capital in cash for 5 lakhs. Then Clue Manufacturing, which is the business started by J, purchases land for cash. So every accounting is done from the perspective of Clue Manufacturing. Then Clue Manufacturing purchases machinery and buildings for cash for 2 lakhs. Then purchases raw materials on credit for 50,000, pays labor wages for 20,000, pays factory rent for 10,000, The last transaction is the sale of materials for cash for $80,000. The corresponding cost of these materials is $30,000. Now let's look into each of these transactions. We'll first start with the first transaction undertaken by Clue. So the first transaction is that Clue has received 5 lakhs as capital from its owner J. So every transaction has 2 legs. One leg is called a debit leg and the other is called a credit leg. So you will understand this better as we move on. So in this particular transaction, one leg is Clue getting a cash of 5 lakhs and the other leg is correspondingly now Clue owes this 5 lakhs to Miss J or the owner, right? Because we said that Clue and its owner are separate. So now that owner has contributed 5 lakhs, Clue has a liability to pay this 5 lakhs to its owner. So on one side here, Clue has an asset of cash of 5 lakhs which has been received, and on the other leg, Clue has a liability of 5 lakhs which it owes to its owner. So both of these accounts are balance sheet accounts. Okay. Cash, we can say, is an asset, right? Your bank balance is an asset for you. Your jewelry is an asset for you. The building that you own is an asset for you, right? So we call these as real accounts. At any time you want to increase an asset in the balance sheet, you will debit that account. And any time asset reduces, you will credit that account. Similarly, if you want to increase a liability, you will credit that liability. So here in this case, liability of 5 lakhs increased, right? So there is a new liability of 5 lakhs. So it's an increase on the liability side. So you will credit that account. And in case you want to decrease the liability, you will debit that account. In this case, this capital account pertains to J. So we call this as a personal account. Okay. So now whenever we have to apply an accounting rule, so we spoke about 2 types of accounts here. One is a cash account, which we call it as a real account, right? Because it is tangible in nature, right? So we call it a real account. And then we have the liability account, which is the capital account, which is in the nature of a personal account, because this amount is owed to a person or maybe a different entity. Ms. J could also be treated as a separate entity, but we classify it as a personal account. So whenever you have to, so the golden rule of accounting for a real account is debit what comes in and credit what goes out. And for a personal account, debit the receiver and credit the giver, right? So now cash being a real account, what do you apply here? Cash came in, right? So debit what comes in. So you debit cash because cash has come in. Since capital account is a personal account, you say credit the giver. Who's the giver here? Ms. J, or the capital account is a giver, right? So your first record of this transaction, when you record this transaction in the book, you will debit cash and credit cash account, debit cash account and credit the capital account. And this recording of this debit and credit entry is called a journal entry, which we will be looking into in detail now. So the initial recording of the transaction, which is the journal entry, has 2 legs, debit and credit. Here we have debited cash because Clue has received cash, and cash is an asset. which is a real account. So we've applied the rule of a real account, which is debit what comes in and credit what goes out. So cash has come in, so we debit cash. The other leg, which is the credit, we have received from Ms. J a capital of 5 lakhs. So that's in the nature of a personal account. Ms. J's capital account is a personal account. And we have applied the rule for personal account is debit the receiver, credit the giver. So here we have credited. So here J is a credit giver. So we have credited J's capital account. So this is the journal entry for this transaction. And what could happen is subsequently there could be a lot of other cash transactions. Similarly, there could be addition to the capital, there could be withdrawal from capital, there could be more transaction pertaining to these accounts. So just by recording a journal entry, there'll be each transaction will have a journal entry. So just by seeing the journal entries, we will not know the balance in cash account at any given point or the balance in the capital account at any given point. So if we want to know the balance in each of these accounts at any point in time, we need to have a record of all the transactions pertaining to each of these accounts in one place. So we create what is called ledger accounts. We post the journal entries into the ledger. So here cash account has a ledger account, capital account has a ledger account. Any ledger account will have left side as a debit side, right side as a credit side. So whatever entry happens in the ledger account is flowing from the journal entry. So here what has happened? You have debited cash, right? So you will make an entry on the debit side of the ledger account. So you'll make an entry on the debit side, 5 lakhs. And what is that entry? You have a capital, right? Then now after recording this transaction, you have your debit side is greater than your credit side. Credit side did not have any entry. So your balance in your cash account is a debit balance of 5 lakhs, which is highlighted in yellow. Next, capital account. Again, your debit and credit sides of capital account. You have two sides. Here, capital is credited. So you will record this as a cash received on the credit side, which is 5 lakhs. Now, if you want to know the balance in the capital account, you have only one entry, which is the credit entry into the capital account, and credit side is greater than the debit side. Debit side has no value. So the balance in this capital account is balance carried forward 5 lakhs. So credit side is greater. So you can say that the capital account has a credit balance of 5 lakhs. So just to repeat, ledger accounts help us to know the balance in each account at any given point in time. Now, after posting all the entries in the ledger accounts, if we want to check the arithmetic accuracy of the postings at any given point, we prepare what is called a trial balance. So a trial balance includes all the ledger accounts with their respective debit or credit balances. So here if you see, cash account we said has a credit balance of, a debit balance of 5 lakhs and capital account has a credit balance of 5 lakhs. So trial balance, left side is debit, right side is credit. So we post the cash account on the left, which has a debit balance of 5 lakhs. We post the capital account, we enter the capital account on the right, which has a credit balance of 5 lakhs. So in this case, the trial balance has tallied, and that ensures arithmetic accuracy. The trial balance must tally to ensure that you have not made any error in posting. So the journal entries, the ledger accounts and the trial balance. So we use all these three to record and verify the accuracy of the financial transactions. Now the next step is to create financial statements or reports uh, that summarize these transactions and helps the end users to interpret the financial health of the organization. So we are going to talk about two main financial statements. One is the income statement and the other is the balance sheet. Now, income statement records the revenues, expenses, profits and losses that an entity will um, incur during a given period. Now here in this case, the first transaction does not have any impact on the income statement because these two are not in the nature of a revenue or expense or a gain or a loss. However, so there's no entry in the income statement. However, this transaction has an impact on the balance sheet because cash account is an asset. So your asset has increased by 5 lakhs and capital account is a liability. Liability has also increased by 5 lakhs, thereby balancing the balance sheet. So here balance sheet asset is equal to the liability, which is the asset side is equal to the liability side. It has to be that way. Balance sheet, both sides have to tally. The next transaction is purchase of land for cash for 1,50,000. So here land is an asset. It's tangible and cash is also an asset. And both are real accounts. So for real accounts, what is the rule that we'll apply? It's debit what comes in and credit what goes out. So land is an asset and it's a real account and land is coming in. We have purchased land. So debit what comes in, we will debit land and we are paying cash. So cash is going out. So credit what goes out. So debit land for 1,50,000 and credit cash for 1,50,000. So this is the journal entry for this transaction. Now when we are posting this to ledger accounts, we'll have to create a new ledger account for land because this is the first transaction. And we already have a ledger account for cash where there's already a posting for capital, receipt of capital for 5 lakhs. So there is a debit entry of 5 lakhs. Now here cash is going out, so we will enter it on the credit side for purchase of land and the amount is 1,50,000. So now after this transaction, if we need to know the balance in the cash account, it still has a debit balance because debit side is greater than the credit side and the balance is 5 lakhs minus 1,50,000, which is 3,50,000. In the ledger account for land, this is the first transaction and we're going to debit the account with 1,50,000, which is cash payment, and the debit side is greater than the credit side. So again, this account has a debit balance of 1,50,000. Moving to trial balance. Now, at this point, there are 3 ledger accounts. One is cash, one is land, and the third is capital, which was a previous transaction. So cash has a debit balance of 3,50,000. That's shown on the debit side. Land has a debit balance of, land account has a debit balance of 1,50,000, again shown on the debit side. Now, previously there was a capital credit balance of 5 lakhs. So now if you add these two, it totals to 5 lakhs. So the debit side and the credit side of the trial balance has tallied. This ensures that it's arithmetically correct. So far we've posted, passed the journal entry, posted to ledger accounts, and we have built the trial balance after the second transaction. Moving on to the financial statements. Since this transaction does not involve any profit, loss, or revenue or expense, there is no impact on the income statement. In the balance sheet, what has happened is we have paid out cash. So cash is reduced, and we in place of that we have an asset increase, which is land. So we have one asset that is reduced and another asset that has increased for the same amount. So balance sheet tallies on both sides. This liability side had an entry for capital as per the previous entry, previous transaction. So capital will be on the liability side for 5 lakhs. That remains untouched. This transaction has an impact on cash balance, reduces cash balance by 1,50,000. So earlier cash was 5 lakhs, it reduced to 3,50,000. And land has been purchased, so land account increased to 1,50,000. And balance sheet is tallied, asset side is equal to liability side for 5 lakhs. The next transaction is purchase of machinery and building for cash amounting to 2 lakhs by CLU. So if you see here, machinery and building are assets. They are tangible. Cash is also an asset. Both are real accounts. So what is the rule, accounting rule for real accounts? It is debit what comes in and credit what goes out. So here machinery is a real account and it's coming in, right? We are purchasing the machinery and building. So we debit machinery and building account for 2 lakhs and we are paying. So cash is basically going out. So we are going to credit the cash account. So credit what goes out. So that's the journal entry for this transaction. And next we post this to ledger account. So now we have a new ledger account, which is machinery and building, and we already have the ledger account for cash. So in cash account right now we have 2 other transactions other than this new one. One is for capital, where we received capital, so cash was debited, and then we paid cash for purchasing land, so cash went out, so we credited cash. Now we are again paying cash for purchasing the machinery and building, so we are crediting. Now if you see the balance in the account, we have 5 lakhs minus 1,50,000 plus 2 lakhs, which is 3,50,000. So the net balance, so it's still a debit balance because the debit side is greater than the credit side. So the debit balance in this account, cash account, is 1,50,000. Now machinery and building account is new. So we have debited machinery and building for 2 lakhs by paying cash. So that's here, and we don't have any other entry on the credit side. So again machinery and building also has a debit balance of 2 lakhs. We are building the trial balance now. So the current, as per the current status of the trial balance, we have a cash balance of 1,50,000, which is the debit balance. Then we have a land account debit balance of 1,50,000, which was the previous transaction. Then the current transaction, we have machinery and building balance of 2 lakhs. And then on the credit side, the capital account remained untouched, which is 5 lakhs. So here the trial balance has tallied, debit side and the credit side totals to 5 lakhs each. This is also another transaction where income statement is not touched because this transaction does not have any gain, loss, income or expense. So there's no entry in the income statement. Coming to the balance sheet, this is also a transaction where one asset has increased in value, which is machinery and building for 2 lakhs, and another asset, which is cash, has decreased in value by the same amount, which is 2 lakhs. So earlier the cash account had a balance of 3,50,000. Now with the purchase of this machinery from 3,50,000, it is reduced to 1,50,000, and machinery and building has increased by 2 lakhs. Land value remains unchanged, which is 1,50,000. So if you total the asset side, it is 5 lakhs. Liability side capital remains untouched, 5 lakhs. So asset side is equal to the liability side. The amount is 5 lakhs. In the next transaction, close purchasing raw materials. So they'll have in stock or in inventory, as we call it, raw materials. So inventory can be of 3 types. A company can have an inventory of raw materials. Sometimes they may be manufacturing certain items. So when manufacturing is in progress, they can have an inventory of work in progress. And once goods are manufactured, they can also have an inventory of finished goods. So in this case, it is raw material that's purchased and which is in inventory. Raw material is an asset. It's a real account. It's tangible. So it's a real account. And the rule for real account is debit what comes in and credit what goes out. So here raw material is coming in. We will debit raw materials for 50,000. And as against payment of cash, this time they have not paid the cash. Instead, they have purchased it on credit. So by credit, we mean when the supplier sends the goods, they will agree with the supplier that the payment will be made after few days, which is called the credit period. So immediately cash is not paid out, but cash is paid out after the or towards the end of the credit period or within the credit period. Okay, so in this case, let's say they have agreed for a credit period of 30 days. So when this transaction happens, cash is not paid out, but there is an obligation to pay. So there is a liability to pay. So instead of cash, they will credit what is called accounts payable, which is the amount due to the vendor or the supplier. Okay, so accounts payable is a liability. It is a personal account because the payment has to be made to a person or an entity. Okay, and the rule for personal account is, accounting rule for personal account is debit the receiver, credit the giver. So here the supplier or the vendor is a giver, so we are going to credit their account. Now after the end of the or towards the end of the credit period, what will happen? We have to pay cash for 50,000. So at that point, what happens? Accounts payable is debited. Basically, this is reversed so that accounts payable has a debit of 50,000 and credit of 50,000. The net balance in accounts payable will be 50,000. Zero after the payment is made. So on payment, accounts payable will be debited and cash will be credited. So at that time, cash is going out, right? So in this entry, debit the receiver, accounts payable is the receiver, and credit what goes out because cash is a real account. When this transaction happens, this entry is not relevant, but this is just for your understanding. Now after passing the journal entry, we'll post these to the ledger accounts. So raw material, it's a new ledger account. Similarly, accounts payable also is a new ledger account. Raw materials is debited for 50,000 and accounts payable is credited for 50,000. So raw material account has a debit balance of 50 and accounts payable has a credit balance of 50. When we build the trial balance, all other entries are untouched. We have a new entry for raw materials, which is a debit balance of 50, and a new entry for accounts payable with a credit balance of 50,000. So both the sides will tally. Total on debit side is 5,50,000 and on the credit side is 5,50,000. This transaction does not impact the income, expense, gains or losses because it's not touching any of the income or expense heads. Okay, so there is no impact on this income statement. There is no entry in the income statement. On the balance sheet, what's happening is raw material, which is an asset, is increased, and On the liability side, we have accounts payable, which is a liability which is increased. So when both the sides increase with the same amount, balance sheet also tallies. So asset side is equal to the liability side. We'll move to the next transaction. In this, Clue is paying the laborers wages amounting to rupees 20,000 in cash. So when we look at the journal entry, what has happened? Wages is in the nature of an expense, right? Wages are paid, which means expenses paid in cash. So the credit leg of the transaction, cash has been paid, which means cash has gone out, and we know that cash is a real account. So credit what? Goes out. Cash has gone out, so we've credited. And on the debit side, so wages account, we call accounts which are in the nature of expense, gains, losses, or incomes. Accounts falling into any of these categories, we call them nominal accounts. So this is the third type of account which we've not discussed until now. So nominal accounts are accounts in the nature of expense, income, gains, losses. Then the rule for nominal account is debit all the expenses and losses and credit all the incomes and gains. Now in this case, wage is an expense, so we will debit, as you see here, and cash account being a real account, we'll credit, because credit what goes out. So that's the journal entry for recording wages as expense. When posted to ledger accounts, it touches the cash account, which already has many entries. Here, last is crediting the cash account for wages amount of 20,000, and wages account is a new ledger account. There's only one entry here. This is the first entry where you have debited wages account with a cash payment of 20,000. So now if you see, cash account still has a debit side greater than the credit side, so it still has a debit balance of 1,30,000, and wages account has a debit balance as well. Debit side is more of 20,000, so debit balance of 20,000. Now bringing this to the trial balance, the cash balance is now changed. It is 1,30,000 debit. Wages account also has a debit balance of 20,000. So if you look at the logic in this entry, we have paid cash, so cash is reduced, and then we have incurred expense, so expense has increased, right? So both are affecting the debit side of the trial balance. Now trial balance tallies, ensuring accounting posting accuracy. Okay, and now moving to the financial statements. Now this is the first entry impacting the income statement. And if you see the structure of the income statement, first we have all the incomes, so the revenues. Then we have all the expenses. And the net of income minus expense will be your profit or loss, right? So here we don't have any revenue or any other income recorded yet. All that we have is, this is the first entry, which is an expense for wages. We are recording that. And when we do this, your revenue 0, your expenses 20,000, which means you have incurred a loss of 20,000, right? And how will this loss reflect in the balance sheet? So we said that the owner we owe the owner an amount of 5 lakhs, which is the capital. Now any profit that the entity makes also belongs to the owner. Also any loss that the entity makes will also be borne by the owner. So here entity has made a loss, Clue has made a loss of 20,000, which has to be borne by the owner. So the amount owed to the owner reduces by that loss. So we have 5 lakhs minus 20,000. Now Clue owes 4,80,000 to the owner. Okay, so that's on the liability side. And on the asset side, what has happened? Cash is reduced. So cash is reduced to the extent of 20,000 by 20,000. So cash is reduced on the asset side, and on the liability side, capital has also reduced by the same amount. So the balance sheet side, if you total the asset and the liability side, it matches, and the total on the asset and the liability side is 5,30,000. Before we proceed with the remaining transactions undertaken by Clue, let's quickly recap our understanding of the different classification of accounts and the accounting rules that we apply for each. So we said that accounts are classified as personal accounts, real accounts, and nominal accounts. Personal accounts are accounts that are related to individuals, firms, and institutions. Example, when we purchase goods on credit, we have creditors. When we sell goods on credit, we have people who owe us. They're called debtors. Similarly, we may have dealings with the banks or even other institutions. So these are all classified as personal accounts. And personal accounts will reflect in the balance sheet either as an asset or as a liability. So if you see our balance sheet here, we covered two types of personal accounts. One is accounts payable, when Clue purchased raw materials on credit. Then there's a capital contribution by the owner, that is also a personal account. So these two are reflecting here on the liability side. Now, if Clue had undertaken any sale on credit, then the person to whom Clue has sold is a debtor, and that will appear on the asset side as accounts receivable. And the rule for personal accounts is debit the receiver, credit the giver. Next, we'll move to real accounts. So real accounts are basically tangible and intangible properties. So in our example, we saw cash, land, machinery, buildings, raw materials. So these are all tangible properties and they are all assets. Okay, and also all the real accounts will reflect in the balance sheet as assets. And the rule applied while passing the journal entry for real accounts are debit what comes in, credit what goes out. Next, we move to nominal accounts. So nominal accounts are incomes, gains, expenses, and losses. So nominal accounts will reflect in the income statement. Okay, and the rule applied is debit all expenses and losses and credit all incomes and gains. So far what we've covered, we've had only one expense, which is for wages. We debited the wages and that reflects in the income statement. Let's look at the next transaction. It is payment of factory rent in cash for 10,000. So payment of factory rent, that's an expense, and all expenses are classified as nominal account. So what's the rule for nominal account? Nominal accounts will be debit all expenses and losses and credit all incomes and gains. In this case, we are referring to a rent expense. So we will debit factory rent and it's being paid in cash. So cash is a real account, right? It's an asset, it's a real account. So the rule is debit what comes in and credit what goes out. Cash is paid, so cash goes out. So cash is credited for 10,000. When posting to ledger accounts, cash account is already there and we have multiple other entries. in cash account, as we saw earlier, we will post the factory rent. It's a debit, and cash is credited. So in the cash account, we will show it on the credit side for 10,000, and still the debit side is greater than the credit side. So cash account has a debit balance of 1,20,000. Factory rent, that's a new ledger account, and here we are debiting factory rent. So on the debit side, you see an entry for 10,000. When we bring this to the trial balance, cash is now reduced to 1,20,000 debit. So that's on the debit side for 1,20,000. And factory rent is another debit item. So that also shows in the debit side for 10,000. Now trial balance tallies with a total of 5,50,000 on the debit side and 5,50,000 on the credit side, assuring arithmetic accuracy. Now coming to income statement. Income statement records all the revenues and expenses, gains, gains and losses. So here factory rent is an expense which is recorded under operating expenses. And what happens with this? The loss increases from 20,000 to 30,000. Now when it comes to balance sheet, on the asset side, cash is reduced because rent is paid in cash. So cash is reduced from 1,30,000 to 1,20,000 now. And on the liability side, capital has reduced because the loss has increased. So when you reduce 30,000 from the capital amount of 5 lakhs, it's 4,70,000. So this is a reduction in the capital. Earlier it was 4,80,000. So balance sheet asset side is equal to the liability side, and it totals to 5,20,000. The last transaction is Clue sells materials which are in stock as inventory, okay, for cash, and the cost of those materials amounts to like 30,000, and they're selling that at 80,000. So now there are two parts here. One is when they sell for 80,000, cash is received for 80,000, and they're recognizing a revenue, a sales revenue for that amount. And on the other hand, what reduces, what is sold? The inventory is sold, the materials are sold, right? So material has to reduce. Also, there is a cost of goods sold. There's a cost to that material which is sold, right? So although they are getting 80,000 as revenue, the entire thing is not profit. There is a cost related to it, which is the cost of the material sold. So that has to be subtracted, and only the remaining would be the profit. So cost of goods sold increases and raw materials reduces on the other hand. So we will see these two as separate and see how journal entries, ledger accounts are posted, and how it impacts the income statement and the balance sheet for each of this separately. So first we'll see the entry for sales revenue recognition. So it's given that cash was received for selling the materials. So cash is a real account. So the rule is debit what comes in. So we're receiving cash for the sales. So debit what comes in. That's applied. And we are recognizing sales revenue. And all the revenues are classified as nominal account. So credit is a debit all expenses and losses, and credit all incomes and gains. So here we have income from sales. So we will credit the sales revenue. and when posted into ledger accounts, the cash account will have a debit. On the debit side, we will post the 80,000, which is the sales revenue, and now the cash account balance has increased. It's increased to 2 lakhs. So the debit side has 5,80,000. Okay, and on the credit side, when we sum this up and take the difference, we have a balance of 2 lakhs, which is a debit balance in the cash account. Sales account is new, so we are crediting the sales account for 80,000. Credit account has sales account has a credit balance. So we will build the trial balance where we will update the cash account balance to 2 lakhs, and then we will add the sales account here, which shows a credit balance of 80,000. So trial balance tallies with a total of 6,30,000 on debit side as well as the credit side. We are recognizing revenue here, so it will reflect in the income statement as revenue sales 80,000, and here we already have recorded expenses for wages and factory rent. So the net of that 80,000 minus 30,000, there's a net profit of 50,000 in the income statement. Now what happens? Capital account 5 lakhs plus the profit of 50,000. This is the total amount that the entity, that is the total amount that Clue owes its shareholder or owner. So 5 lakhs plus 50,000. So it's not a loss. So we don't subtract, we add now. And that amounts to 5,50,000 on the liability side. And on the asset side, we have a cash increase. So cash increases to 2 lakhs. And the balance sheet tallies on both the asset and the liability side, totaling to 6 lakhs each. So the other part of this transaction is that the raw materials are reduced from the stock. So we had a raw material balance of 50,000, out of which we have sold 30,000 here. So raw material must reduce to that extent. So raw material is a real account, it's an asset. So the rule is that debit what comes in and credit what goes out. So here raw material has gone out, it's sold. So we will credit the raw material account by that amount. And on the debit side, when 80,000 is sold, we cannot recognize the entire 80,000 as a profit. There is an associated cost to it, which is the cost of raw material that is sent. So that is an expense. The cost of goods sold, which is the material cost, is an expense which has to be debited. So this is a cost of goods sold is a nominal account, and the rule is debit all expenses and losses. So we will debit COGS and we will credit the raw material account, which is a real account. Coming to ledger accounts, raw material account already has the initial entry when the raw material was purchased for 50,000. Now from that 30,000 has been sold, so the account has a balance of debit balance of 20,000. Debit side is more than the credit side, so debit balance of 20,000. Cost of goods sold has been debited for 30,000, so that account also has a debit balance of 30,000. When we bring this to the trial balance, the raw material balance is 20,000, cost of goods sold is 30,000. When the figures add up and the trial balance tallies on both sides, confirming arithmetic accuracy. In the income statement, the cost of goods sold is an expense, so it has to be reduced from our sales revenue. Sales revenue is 80,000, and the cost related to the sales, which is a cost of goods sold, is 30,000, giving rise to a gross profit of 50,000. Then we have other operating expenses that we have paid, like wages, factory rent, which has to be reduced. So the net profit is 20,000. So now Clue owes its owners or the shareholders 20,000, which is a profit that Clue has made, plus the original capital of 5 lakhs. So the liability of Clue to its shareholders is 5 lakhs plus 20,000, which is 5,20,000. Whereas on the asset side, raw material has reduced from 50,000 to 20,000. So here there is a reduction in capital when compared to what it was before this transaction, and on the asset side there is a reduction in raw material, thereby tallying the balance sheet both on the assets and the liability side. Now with the current set of transactions completed by Clue, let's take a look at the financial position from an end user perspective. As an end user, how will we interpret the financial health of Clue based on their income statement and the balance sheet? So if you look at the income statement, which is given on the left, we see that the gross profit margin, which is the gross profit divided by the revenue, that is 62.5%, and the net profit margin, which is the net profit divided by the revenue, which is 25%. So we see that the gross profit margin and the net profit margin look good, which means the business is profitable. But if we look at the expenses, we see the operating expense ratio is 30,000 by 80,000, which is 37.5%. And we can see that the expenses are in control. They're not overshooting. Balance sheet side, if we look at the assets and the liabilities, maybe one conclusion that we can make is, we can see that the cash, it makes up, say it's about 35% of the total assets of Clue, which actually shows very strong liquidity. Similarly, Clue does not have any other long-term liabilities, like there are no loans or any other similar obligations. And also the liability that they currently have of 50,000, that's only around roughly 8.8% of the total funding of Clue. So this is good. And when Clue started, it started with a capital of 5 lakhs. And now that is increased from 5 lakhs to 5 lakhs 20,000. So there is also a so basically there is it's profitable, and net profit has added to the capital. So it reflects good retention and reinvestment of earnings. So this is how end users will utilize the financial statements to make different kinds of decisions depending on the purpose or who the end user is. So with that, we come to the end of our end-to-end example, which I hope helped you understand how a company maintains its books of accounts and does the reporting of its financial performance and the financial position. So what we have covered includes, on the accounting side, passing journal entries. So we said that the journal entries are the first record of the transaction. So first place where transactions are recorded in the order in which it occurs, and every transaction will have two legs, a debit leg and a credit leg, and it will go into the respective account. Depending on the nature of the transaction, it gets into the different accounts after applying the different accounting rules, which we have already discussed. And from journal, these entries are posted into ledger accounts, also called the T accounts. Basically, ledger account is a summary of all the transactions happening under one account, and it helps to understand the account balance at any given point. And from there we have trial balance, which lists all the ledger accounts balances at a given point, and it helps to check the arithmetic accuracy of the ledger postings. On the reporting side, we covered income statement and balance sheet. There are other reports as well, like the statement of cash flows, statement of comprehensive income, and statement of changes in stockholders' equity. So all these are important from an end user perspective to understand the financial position of the company. But our current focus has been income statement and balance sheet, which are the two key financial reports. So income statement helps any user to understand the financial performance of the company over a period. So we see that if you're taking for 1 year, all the transactions happening in that year reflect in the income statement. So it gives a accounting performance over a period. Balance sheet, on the other hand, it's a statement showing the financial position at a specific point in time. So it shows the firm's or the entity's assets, liabilities, and the equity. When companies are maintaining their books of accounts and preparing the financial statements, there are certain accounting principles that they need to adhere to. The first principle is the accrual principle, next is the consistency principle, and third is the matching principle. So basically these guidelines ensure that the financial statements are prepared consistently and they provide accurate and comparable information. So what is accrual principle? Accrual principle says that the revenue and the expenses, they are recorded when they are actually earned or incurred and not when the cash is received or paid. So like an example would be, say if a company delivers services in December, but they're going to receive the payment. They receive the payment only in January. Under the accrual principle, the revenue must be recorded in December and not when cash is received, because December is when the company is earning it. Next is the consistency principle. By this we mean that once a company chooses an accounting method, that must be applied consistently from one period to another. Let's say a company uses straight line method to depreciate its assets. So it must continue to use the same method every year unless there is a proper justification for a change and it is disclosed. So if it suddenly switches, say to a different method, say double declining balance without an explanation, it basically violates the consistency principle and that is not acceptable. Third is the matching principle, and this means that the expenses should be recognized in the same period as the revenue they help to generate. So let's say a company pays sales commission in January for sales made in December. These commissions should ideally be recorded as a December expense because they relate to December sales. So that's the matching principle. With that, we come to the end of this session. We covered the classification of accounts, the golden rules of accounting, journal entries, ledger accounts, trial balance, income statements, balance sheet, as well as some key accounting principles. So understanding accounting actually becomes much easier when you follow each transaction from the journal entry through to the trial balance and finally into the income statement and the balance sheet. So I encourage you to practice this end-to-end flow as it's the most effective way to grasp the financial reporting concepts. I hope you found this session useful. Thank you.